Good morning. Welcome to the presentation. In last week's class, we defined financial instruments, we identified different asset classes, and discussed the financial markets. In this week's presentation, we are going to talk about stocks. We'll define the ownership rights that stock owners have. We'll talk about the markets in which stocks are traded in and the exchanges that those stocks are traded on. In corporate finance, many companies either occasionally or regularly must raise money for a variety of reasons. Could be reasons of operations, perhaps they need to cover payroll or to adjust inventory levels, or simply for other operating expenses. Or perhaps the corporation wants to expand, so they might need to purchase land or buildings, build factories or other real estate. They might need to purchase equipment or raw materials or to hire new employees. So how does a company raise money? In the area of debt financing, a company can borrow money from an outside source with the promise to repay that principal and interest. So we can either borrow money from a bank or we can issue bonds, bills, or notes. And borrowing money isn't necessarily bad. Debt is a form of leverage, and it is a common and generally cost-effective method for raising money. And even the corporations with the healthiest balance sheets include some amount of debt, and in most cases, the principal and interest payments are tax deductible. Another form of corporate financing is equity financing, and this is when a company sells a portion of itself to an outside source. Essentially, they are selling shares of the company. And what is a share? A share is a unit of ownership in the company. And companies decide how many shares to authorize when they incorporate themselves, and the number of authorized shares is somewhat arbitrary. Usually, some of the authorized shares are issued to the founders of the company, and some of the shares are retained by the corporation. Here's an example. If we form a new corporation and we authorize 1 million shares of stock, if the total combined value of the corporation's assets is $100,000, then how much is each share of the company worth? Well, here's the formula. $100,000 of value divided by 1 million shares. The value of each share should be 10 cents. Stock is an ownership right in a company, and a stock certificate is a legal document that certifies ownership of a specific number of shares, either one or more, of the company. A shareholder, sometimes referred to as a mutual shareholder, is an individual or another company that legally owns one or more shares of stock in the company. And there are two main types of stock. There is common stock and preferred stock. A privately held company is a company whose stock is owned by a relatively small number of shareholders, and that stock is not traded publicly on a stock market. A publicly traded company is a company who was formerly privately held, which was granted permissions by the Securities and Exchange Commissions, assuming they're a U.S.-based company, to sell their shares on the stock market. An IPO, or an initial public offering, is the event in which a company offers its stock to sale to the public for the first time. And the issuer, the company that's issuing their stock, generally will hire an underwriting firm to help determine the best type of stock to issue, the appropriate price, and the best time to bring those securities to market. Well, what are a shareholder's rights? A shareholder has the right of distributions of company income. They also have the right to a company's assets during liquidation. They generally would have voting rights. For example, they could vote for the board of directors. And they have the right to shareholder resolutions. An annual meeting where shareholders hear business reports and future plans and elect board of members is referred to as the shareholders meeting. And especially for large companies, only a small percentage of shareholders attend these meetings in person, and many shareholders vote by proxy. Now, proxy voting is the procedure for a temporary delegation of your voting rights to another voting member. A shareholder resolution is a proposal. It's an actual document that gets filed with the company by one or more of its shareholders, through which they request a vote on a specific issue at the next shareholders meeting. Section 1480 of the Securities and Exchange Act provides the legal and regulatory framework for the shareholder proposal process. So who can file a resolution? Well, anyone who owns at least 2,000 shares, or 1% of all of the outstanding shares of the company, and who has been a shareholder for more than 1 year can file a resolution. The company's proxy statement is a document that describes the procedure for filing a proposal and declares the deadline for submission. More information can be found at www.sec.gov/edgar/searchedgar www.sec.gov/companysearch.html. This website will allow you to search for any U.S.-based company and find their particular proxy statement. Now, the SEC allows proposal omissions. A proposal, for example, that deals with an ordinary business issue and that is similar to a proposal in a prior year that did not receive a certain number of votes can be omitted from a future stockholders meeting. Or a proposal that requests that the company perform some illegal acts, or a proposal that contains false information, or a proposal that relates to a personal grievance against the company. Each of these are examples of a proposal that can be omitted by choice by the company at the next shareholders meeting. Well, let's compare the two primary types of stock, common versus preferred. Both common stock and preferred stock provide ownership in the company. Common stock generally comes with voting rights, but it is rare that preferred stockholders have voting rights. Conversely, preferred stock generally grants a dividend to the holder, and a dividend is not guaranteed for common stockholders. If the company declares bankruptcy, preferred shareholders are paid first, and if there's any remaining assets, then the common stockholders would be paid. Common stockholders generally have preemptive rights, and with regard to price fluctuation, common stock's value is generally affected by the fundamentals, technicals, and the general economic forces within the market. However, the value of preferred stock is generally affected by changes in interest rates. You'll recall that the Securities and Exchange Commission within the U.S. has three primary goals. First, to protect investors. Second, maintain a fair, orderly, and efficient market. And to facilitate capital formation. A stock exchange is a company or organization that has registered with the Securities and Exchange Commission and provides trading facilities for stockbrokers and traders. A stock market is a general term that refers to a marketplace that consists of one or more stock exchanges where equities or stocks are bought and sold in an organized way. There are many stock exchanges in the United States. The three largest are the American Stock Exchange, NASDAQ, and the New York Stock Exchange. The largest stock exchanges in the world are shown here. The New York Stock Exchange, the NASDAQ, the London Stock Exchange, and the Tokyo Stock Exchange are the four largest. Next week, we'll discuss derivatives, we'll define underlying assets, and we'll talk about futures and options contracts. Please visit our website at www.fgam.us and let us know if you have any questions or comments. Good luck with your trades.